I think there's a real valid reason for the central banks to try to limit the price of gold, because obviously their policies verge on the Ponzi here when you just end up buying all of your country's debt, whether you're Japan or the U.S. or England. And those of us who would watch us would look for some tell as to whether the system is buying into it or not. And we all know the tell would be the price of gold and silver. And they don't want the tell to be read. In other words, if we all saw the price of gold and silver hitting new highs, I think we'd realize that the policies of the central planners were likely to cause hyperinflation. When I first got involved in gold in a serious manner, which was 2000, essentially right at the bottom of the market, I was sort of guided by a book written by a gentleman who called the 1998 Gold Book. His name is Frank Veneroso. And he surmised, sort of Gatto-like, that the central banks had been supplying the market and suppressing the price of gold. And his conclusion was that there really was more demand than supply already back in 1998 of 800 tons a year. And of course, the point of reference is the size of the gold market, which is about 4,000 tons. And I thought, you know, I think he's probably got a point here. Looks to me like there's more demand than supply. And so that's what brought me into gold. That and the fact that I felt very much like we were going into a bear market well before the NASDAQ peaks. And there's only one way to survive in that market, and that's to own real assets. So those two things were kind of my guiding principle. We have been aided and abetted along the way by the financial crisis and the reaction to the financial crisis, the things you were mentioning, quantitative easings, conservatorships, LTROs, just massive money printing to save the financial system. Two, bank runs, which would cause people to go to gold. So these have all created tailwinds that make one believe that the price of gold can still go many times higher than it is today.
Okay, so then let's talk about, because I want to ask what's changed in the landscape and the dynamics perhaps in the last year and a half, because in the summer of 2011, following the U.S. debt downgrade, of course the Eurozone crisis was still a major concern, and every day it seemed like gold was hitting a new record. I can remember just watching it and reporting on it and going, whoa, what is going on? I mean, it went from 1,600 to 1,900 in less than 3 weeks, and now, in this past year and a half, gold just hasn't moved much. What has changed?
Right. Well, you have to be kind of circumspect about what might really be happening here. And it happens to be my view that when the crises are evident, the powers that be do not want the crisis to be evident. And knowing that gold and silver are, in essence, the canary in the gold mine, I think there is pressure brought to bear on gold prices. I think there's a real valid reason for the central banks to try to limit the price of gold, because obviously their policies verge on the Ponzi here when you just end up buying all of your country's debt, whether you're Japan or the U.S. or England. And those of us who would watch us would look for some tell as to whether the system is buying into it or not. And we all know the tell would be the price of gold and silver. And they don't want the tell to be read. In other words, if we all saw the price of gold and silver hitting new highs, I think we'd realize that the policies of the central planners were likely to cause hyperinflation.
Okay, so then let me ask you more about the central planners, because they do seem that they've been effective in some regards in doing what they want to achieve. So in the same time that we're talking about where gold has really come down or kind of stayed in the same place, September 22nd, of 2011, the S&P 500 has risen 25%. So we're here in year 4 after 2008. Many would argue the fundamental problems that got us into the 2008 crisis have not been addressed. So does this prove that not only can the Fed keep equity prices higher, but that maybe if you're an investor sitting there and you're looking at this and you're saying, you know, I just missed this rally, maybe the Fed and central banks really can keep equity prices higher, and if they're committed to doing so, which they certainly seem to be, shouldn't I just get in? Do you think people are sitting there saying this now?
Well, I think, Lauren, what you have to do is you have to look at the long-run impact again, and who knows when it finally breaks. But, I mean, I look at the Fed buying, let's say, 90% of the bonds is totally ludicrous. The Japanese probably buying more than 100% of their bonds. It's grossly impractical. And of course, the result of these purchases is to drive interest rates almost to nothing. But it's an artificial rate. It's not where bonds should be trading, and you can't do it forever. And you know, when the Fed says, you know, they're going to work their way out of all the bond purchases, which they used to talk about. I mean, there's absolutely no way now that anyone could imagine that they would ever be able to delever their balance sheet. I think they're in it for the long run. Mm-hmm. And yes, I think by driving interest rates lower, you have a positive tendency on stock prices. But I think if we all think that the interest rate at 1 or 2% for bonds is ludicrous, that in turn causes stock valuations to be ludicrous, because if we start moving up in interest rates here, mm-hmm. the whole situation in all countries from a deficit perspective starts changing markedly here, as you have to pay market interest rates on your bonds and not some illusory temporary rate. So it's not a policy that anyone could imagine is sustainable here, mm-hmm. Not without creating some kind of serious inflation. You can't just keep printing money without there being inflation. And it's sort of come to my mind that the reason they control the price of gold and silver is that's because the first place everyone would go. They're not going to go and buy wheat and oil and other things like that. They're going to buy gold and silver. So if you keep the price of gold and silver controlled, mm-hmm. you probably prevent what would appear to be the start of an inflationary era. Mm-hmm. And that's why I think they've leaned on gold and silver in particular.
All right, we're talking about precious metals. Before the break, we were focused on gold, but we don't want to overlook silver. Okay, I know we don't give it as much play, but it is one of Eric Sprott's fortes. So we were sure to ask him about it.
Right. Well, Lauren, first of all, I'm very happy that you don't spend much time on silver.
Oh, well, good. I'll pat myself on the back. Now tell me why.
Statement. It's a statement that people don't look at silver, right? Uh-huh. We have these silver trusts, and I go around and see various people on silver and institutions, and not many people spend any time looking at silver, which I regard as a great thing, which means, you know, it can only change to the better. I would only say this. I think silver will be the investment of this decade, whereas gold was the investment of the last decade. Silver has outperformed gold. It's more volatile, however. And I kind of take a long-term view on these things. If I was to give people advice, what do you do with your money? I believe that silver will trade down to a 16-to-1 ratio to gold. So let's imagine that 2 years from now, gold's $3,000. That would imply that the price of silver could almost be $200. So your return would be 300% more if you have the patience and can stomach the volatility. I think silver will be by far the better investment going forward.
First, let's take a look at what hard money means, okay? It's money that's backed by a hard, tangible, lasting material so as to retain its relative value over time, thus acting as a reliable store of value. So it's, you know, it's pretty intuitive. For example, before 1971, the U.S. dollar was redeemable for a set quantity of gold. This meant the dollar was sound or sounder currency, certainly than it is now. Now, advocates of a gold standard or some other form of commodity-based hard currency point to the huge growth in debt. Take a look at that, total public debt, as well as other liabilities as a direct consequence of having money that isn't tied to anything tangible and whose value fluctuates with the whims of you-know-who, central bankers. This is otherwise known as, of course, fiat currency. Now, in a world of sound money, debts that cannot be repaid will not be repaid, and thus write-downs and bankruptcies must occur, and debts cannot simply be papered over through this, money printing. Now, even Thomas Jefferson, to go back a while, in the 1780s, wrote about the need for understanding the value of the dollar. He said, if we determine that a dollar shall be our unit, we must then say with precision what a dollar is. And in the 1700s, after Rhode Island issued vast amounts of unbacked paper money, George Washington wrote to the former deputy governor of Rhode Island and said, paper money has had the effect in your state that it will ever have to ruin commerce, oppress the honest, and open the door to every species of fraud and injustice.